Hello, my name is Andrew Pasek, and today I'll be covering the concept of private placement offering, the details behind the private offer, the term sheet, and the due diligence conducted. So what is PPO? PPO, according to GrowthInc, is basically a prospectus for shares in a private company, much like the sort received by an investor in a stock, mutual fund, or publicly traded securities. It details all the terms of the investment, requirements of the investor, the proper disclaimers and disclosures related to the business and equity. And what more specifically is the primary purpose of PPO? Well, the neat thing about a PPO is it builds liquidity without having to IPO. Moreover, it does not have to abide by the same regulations for the 1934 Securities Act for public issuance of securities by going through Regulation D, which will be elaborated later, that gives the company more leverage to impose their needs. So who are the intended audience for a private placement offering? Well, it's curtailed towards wealthy investors and institutional investors like investment banks, pension funds, and insurance funds. Moreover, investors who have a net worth over $1 million, either alone or with a spouse, or individuals who earn income that exceeds $200,000 or with a spouse $300,000 for the prior 2 years and expects to earn that concurrently, and all under the scope of the Federal Securities Act of Regulation D, Rule 504 and 506. However, there are exceptions to this rule. That is, that individuals who are sophisticated under Rule 506B that accredits the investors due to sufficient knowledge and experience in business matters that sanctions for wherewithal of merit and risk for the prospective investment. The limit is set at 35 investors who could be under the sophisticated rule of 506B. It basically states that there is a cap within a cap of qualified investors for a PPO. So when constructing a deal, what are the characteristics that encompasses the overall inner workings of a PPO? The characteristics include but are not limited to the company's scope of operations, which is where they operate, the financial statement analysis and financial projections, which is the valuation of the company and the future prospects, the offering terms and details, such as how much you would like to raise, the descriptions of securities, or rather if they are convertible, to what valuation measures are used to convert and how long the term is. Risk factors include the intrinsic and the market risk factors. Estimated use of proceeds are stated so the investor knows the purpose of the PPO. Business and management, which deals with the corporate governance. The litigation process is ever evolving when coming up with caps and terms and conditions. Therefore, when constructing a deal, it's subject to change. So what are the advantages and disadvantages of conducting the PPO? The advantages include the issuance fees, which are absent due to the privacy of not having to go through an underwriter at an investment bank. It's also very flexible as it meets the needs of financial investors, and bonds are not required to be rated. The disadvantages include that the issuance might not be the best for the investor because they require an additional equity for the investment for sort of risk inherited due to the PPO. Moreover, due to the lack of credit rating, sophisticated investors have to conduct their due diligence by creating their own synthetic debt rating when going through a credit rating bureau like Moody's and S&P. Furthermore, the investors might not buy the bond or equity if it's not backed by collateral or dividends. Also, it's hard to raise more than a certain amount of capital. Therefore, the pooling requirements is specific rather than general, which for its intended purpose might be limiting. So here are some measures of regulation. The Regulation D offerings is implemented to circumvent the tedious process of going through an SEC public offering. If these stipulations are not met, then the private offering is held as a valid placement. Moreover, it principally holds to investors that are sophisticated with merit to their diligence withstanding in their SEC oversight. The Regulation D Rule 504 limits the amount of $5 million capital with a 12-month period as long as it's not a blank check company. The Regulation D Rule 505 was phased out and incorporated in 504 in 2016 as it allows for sales to be unlimited number of investors and 35 uncredited investors, however sophisticated. The Regulation D Rule 506 is the amount of capital that is not capped, as they are able to raise unlimited amount and that chooses the information to give to their accredited investors, which is here we have an accompaniment of FINRA rules for the placement of securities. The FINRA Rule 5122 adheres to the private placements of securities issued by members, which goes over the control entity, disclosure requirements, filing requirements, and exemptions, and more. The FINRA Rule 5123 adheres to specifically the filing requirements and exemptions. FINRA Rule 21111 goes over the suitability clause, asks for reasonable basis, customer-specific, and quantitative suitability. The FINRA Rule 3110 focuses on the supervisory role, which is pursuant to the preceding rules. Moreover, the function includes the specific individual responsible for each review, supervisory activities, frequency of review, and the manner of documentation. So what is a term sheet? The term sheet is basically the nature of its investment and its specific offering terms. There's also the confidentiality of the agreement, which is protected from being shared to a third party, which is the no-shop clause. It's supposed to prevent target company from searching for other financing within that period of time that the confidentiality agreement states. Under basic provisions, it includes the type of security offered, such as preferred stocks, warrants, or common stock. The valuation of companies discussed is the dividend policy, whether or not they're going to be paid cumulatively or non-cumulative. There's anti-dilution measures, which is the protections for shares that are issued below its previous price. Also, there's a discussion of the directors and the board. Redemption clause indicates when the company is to buy back their shares. There's transfer restrictions, which is intended to stop shareholders from selling to third parties. There's preemptive rights, which are rights for shareholders to purchase the shares when the company issues tag-along and drag-alongs, which for the majorities are able to drag along the minority shareholder to sell their stake in the company. There's earn-out provisions, which are given if the company hits a specific target, such as profitability and their earnings. There's a condition precedence also, which explains what happens from the time the term sheet is signed to the completion of the investment. And those are some of the details within the term sheet. So when constructing a deal, there's a part called due diligence, which has to deal more specifically with their financial analysis and financial projections and their management. So the due diligence goes over the factors that assesses the situation of the company. The factors include, but are not limited to, the market cap, the profitability analysis, the competitors in industries, the risks that comes with that, the valuation multiples, management and share ownership, the balance sheet, the stock price history, and stock dilution. And those are the 8 core factors that are within the due diligence. So this wraps up my presentations, going over what PPO is, its intended audience, the construction of the deal, the advantages and disadvantages, the regulation, the term sheet, and due diligence. Thank you.